Hello, testing, testing. Hi, good evening, everyone. Hi, hello. All right, so I believe that all of you have just finished your dinner or having a dinner right now. So thank you for joining us here today for this webinar, Re-engineer Your Trading with CFDs. So I'm just would like to check, right? So how many of you do not have any stock trading account currently, regardless of which broker? So you please raise your hand on in the Zoom so that I can see how many of you do not have. Just want to do a survey only. Thank you very much. So meanwhile, for the rest, if you think that this webinar would be beneficial to you, please help us to share it to your friends and relatives so that they can also learn something we can learn from each other today for stocks and CFD. So CFD is actually an alternative product, or it's a OTC product that for you to make your trading more flexible compared to stocks alone. So it's a bit for myself. My name is Yong Shern. I'm a dealer from this Phillip Securities CFD department, contract for differences. Okay, so this is a disclaimer. Okay, so I hope that you guys have shared this webinar to your friends. So I'm going to begin right now. So first of all, what are CFDs? So contract for differences is actually a derivative product that traded over the counter, where you can participate in the price movement of the underlying securities or assets, which you do not own the underlying asset. It is a contractual agreement between you and your broker, such as PhillipCapital. Then this contract, right, is actually settled between the opening and closing price of the underlying assets. So it can be shares and other products as well. So by comparing this CFD with stocks, and you also can compare it with other products such as futures. So the underlying for stocks is the equity, the issuing company, the securities, whereas for CFD is the respective assets such as indices, equities, forex, and so on, which I'm going to talk more in later. So for leverage, normally stocks is like you deposit $10 inside, you can only trade up to $10 unless you have some margin facility. Whereas for CFD is a trade on margin, so you can leverage to amplify your trading power. Whereas for expiry date, this is applicable for futures. For stocks and CFD, you do not have. You can hold CFD as long as you want, but just take note that there are financing charges applicable to these holding positions. And with the ability to do short selling for CFD, it's very direct. You just click the sell button to do short selling if you think that the market is bearish. Whereas for stocks, right, some markets you can short, such as Singapore with Phillip. You can do it through having a SBL account, securities borrowing and lending account, where you can arrange for short selling, but it's subject to settlement cycle. And you also can do intraday short selling for Singapore market. But whereas for US and other foreign market, I think that you can only use CFD for now with Phillip. So by using short selling by doing this with Phillip CFD, so it is the whole process is very easy and seamless. So I mentioned in the previous slide for short selling the advantages for CFD. And then leverage. So some of our products, such as equities, allows you for 10 times leverage. Some may even offer up to 20 times, depending on the product itself, and as well as the quality of the asset. And so we also provide multiple asset classes. And the fourth advantage is hedging. So you can use CFD for hedging. I believe that a lot of you is very new don't know what is hedging. So I'm going to talk in detail in the next session. I hope you guys can stay tuned. So just take note that the leverage can be a double-edged sword. Just bear this in your mind. So as I mentioned earlier, so you can do short selling with CFD. When you purchase the stocks, I think most of you anticipate the share price is going up. That's why you purchase the stock, you make the entry. So we call it go long. So you go long by through buying the share. Whereas if you think that the market go down, how can you profit from the movement? Or the market is going to be very volatile. How can you profit from that movement? So you can use CFD because CFD is bi-directional. You can either go long by through buying, anticipating the share price going up, or short selling, doing a short selling with CFD, anticipating the share price is going down, or you can do hedging. There's more. I will elaborate more in the next slides, next few slides. So you are not restricted to the market direction. You can participate either market is bullish or bearish. So this is an example for profit and loss on a conventional stock. So if you purchase 10,000 shares of a stock A at $2, when the stock price rises to 2.1, so you are making a 10-cent profit with a 10,000 shares. So your profit is $1,000, excluding those commission charges. So in the event the share price go down to 1.9, so you are making a loss of $1,000 in this case. However, if you use the CFD to do the short selling, you can make the $1,000 profit by doing a short selling. So this is one of the biggest advantage of CFD for equities, indices, commodities, and forex. So for margin wise, so a lot of people may not be familiar with margin. So traders or investors can use the leverage, the power of leverage to enlarge your positions while just having to with a very small initial deposit, a small cash outlay. So leverage can amplify your both returns and losses. So for example, you can see from the screenshots below, if I'm intending to buy an Apple share, 100 Apple share, so buy at the bid ask price 126.83. My cash outlay would be $12,683 US dollar. And whereas if you use CFD with a margin ratio of 10%, instead of coming out with full value, a full contract value of $12,683, you just need to come up with a 1,268.330 cent US dollar to buy this to initiate this position. So this gives you an leverage of 10 times, 10x leverage. So in this scenario, the calculate P&L, which you may find similar to previous slides, but then this time I'm going to tell you about the return on equity. So same case, you purchase the shares at $2 and purchase a CFD at $2. Your initial cash outlay for 10,000 shares is 20,000 for the normal equity, whereas for CFD is $2,000 because of the 10% margin. So in the event the share price go up to rises to 2.1, so you're making 10-cent profit, $1,000. But if you divide this with your capital, by your capital, 1,000 divided by 20,000, so you are making just 5% of the return. Whereas if you use CFD, you can make 50% return because your initial cash outlay or your capital is just $2,000 only. $2,000 only. So $1,000 divided by $2,000, which gives you a 50% return, which is way higher than the if you use the conventional stock without leverage. So, however, this take note that CFD is the leverage is double-edged sword. So in the event the share price go down to 1.9, you are making a loss of 1,000. So if you use conventional share, is 5% loss. Whereas for CFD will be 50% loss as well. But all these transactions exclude commission charges and financing charges. So in the third case, in the third scenario, if you use a CFD to do short selling, you are making a 50% returns as well. For shares wise, if you want to do short selling, as I mentioned earlier, it's subject to a lot of processes. In Singapore market, you need to have SBL account, or either you can do it intraday, but do take note a lot of restrictions, and this seek for your professional advisor on how to do short selling with the Singapore equity. For our US market, I would strongly suggest you to use CFD because I think that's the only channel, and that's the easiest channel for you to do short selling. Singapore market as well. So CFD, I think, is the best and simple processes. Okay, after talking about what are CFD, we mentioned about leverage, short selling. So what are the instruments available for CFD? So first of all, of course, is this equity CFD is just like normal DBS, OCBC Bank, Capital Land, or maybe Apple, Microsoft, Tesla. All these shares, we also provide CFD. So it's a contractual agreement between you and PhillipCapital. So everything is cash settled. Unlike normal equities, you have a settlement cycle of T+2. CFD is very direct. Buy, we just debit the money from your account. When you sell it, will credit your profit and the initial margin back to your account immediately, not subjected to any cash settlement cycle. And I mean, not subjected to any share settlement cycle. So this share price, right, is actually exactly mirroring the cash market movement. So there's no additional spread involved. And we also provide free live prices for selected markets, such as Singapore, US, because actually US market, a lot of them don't provide free live price. So whatever you see on the screen actually is delayed price. So you can just simply subscribe using our reward program. It's totally free and can subscribe to live price so you can see the price. So can make this allows you to make your trading decision better. So for index linked stocks, right, the margin can be as low as 10%. So it's effectively is a 10 times leverage. So your $1 can buy up to $10 of this shares. So with CFD, right, you can see here there are three DBS here. So the first one is CFD, and then second one is CFD DMA. I'm going to talk about this in the next few slides. This is called direct market access. So we are currently talking about this light green. So when you go to Poems 2.0 website, the trading platform, right, you can, when you search DBS, it will come up at least 3 results, which are showing these 3. So this one is CFD. I'm talking about this. So equity EQ, the blue color one, is a normal conventional share. So you can see that the last price is the same, the bid and ask is the same. So we don't quote additional spread. It's totally reflecting the cash market bid and ask. However, for the operation of this CFD, which I'm going to explain further in terms of how to buy and how it works, how the order can be filled. So we can access to 8 global stock exchanges. So actually it's a lot. This covers a lot of popular markets among the local investors as well as our foreign investors. So Singapore, we offers more than we offer large amount of counters, including both CFD and DMA, which have more than 1,000 of counters. And then we have Malaysia as well, China, Hong Kong, US, UK, Australia, and Japan. So some of these market we allow for short selling, in fact, like such as Singapore, Hong Kong, US, and I mean UK market. So you can do short selling for these markets if you think that this market is going down, or maybe you want to do hedging. So for DMA, direct market access CFD, this is we offer it for Singapore market SGX. So you can access to a pre-opening and pre-closing market, so which is before the market open or after 5 p.m., which is the closing auction. So you can buy or sell your shares during that period. Whereas for CFD, you can participate during the market open time, market hours. So you can participate in this order book of the exchange. So your orders will be reflected on this exchange order book. So you can use the market depth to check your orders. So your order will be filled based on the actual exchange transactions. So for example, got people, you're buying 1,000 shares of DBS, so it will be reflected directly on the exchange order book. So the margin same is a 10% for the index linked shares, such as DBS, these big names. Okay, so the comparison between CFD, DMA, and CFD, right? Okay, so for CFD, your order may or may not be reflected on this exchange order book. And this order is filled by Phillip Securities based on the bid and ask price. So you can check the order status on your trading platform, such as Poems 2.0, Poems Mobile 2.0. Whereas for CFD DMA, right, you can actually see your orders on the exchange order book, such as using the market depth, time and sales. So your order will you send via these Phillip Securities, you send to the exchange directly. And then these order status are such as done, the order being done, rejected, or withdrawn will be reflected on your Poems platform as well. So for commodities wise, we have gold and silver. There's no expiry for this contract. We offer competitive spread, and then margin is as low as 20% only. So this mini contract, we also offer mini contracts for gold. Yeah, you can see from the screenshot below, where there's one, the first one is USD $1 gold, and the other one is $100 gold. So one tick of movement. So for example, this gold is trading at 1854. So when the gold moves up 1 point, if you're doing a long, your profit will be $1 for this USD1 contract. Whereas for the $100 contract, when the gold price changed to $1,855, your profit will be $100. And same goes to the other way around. If you're doing short, or maybe if the things go against you, then your loss will be the same thing. For silver, currently we are offering USD 50. So a lot of people use gold for their hedging purposes, or such as the very famous Ray Dalio. A lot of people may have heard of him. So he's actually strongly pushing gold in the during the late last year or early this year. So I think a lot of people put gold as part of their one of the element in their portfolio to do some hedging, to hedge against volatility. So for world indices, I believe that all of you have heard of STI index, Dow Jones index. So we offer multiple contract sizes to allow our clients to trade more in a more flexible way, and with a very competitive spread. You also can receive dividends, unlike the futures. So with CFD index, you can receive the cash dividends paid out by the component stocks. So you can see that here are the few popular indices that we are offering. Singapore index, which we call it SIMSKI, which is $20 per tick. Singapore Straits Time Index, this is a cash derived index, Singapore dollar $5. S&P 500 index, we have two sizes. One is $5 and the other one is $1. We just launched it a month ago. So if you want to use the $1, right, you can buy up to 5 contracts. You can buy slowly, like every level also buy 1 contract, which is you also can make out to $5 depending on your trading strategy. Wall Street Index is considered as the Dow Jones, the 30 stocks index. So for S&P 500, right, today I think next Monday they are welcoming a new member, Tesla, joining this S&P 500 index. So for US Tech 100, it's a NASDAQ one, which includes those big tech companies. We have 2 sizes as well, $5 and $1. Hong Kong Hang Seng Index, $5 in Hong Kong dollar. And we also have other indices such as Nikkei 225 and Malaysia FVM KLCI. These margins start from 6%, which effectively give you a 60.77 times of leverage. So some of these contracts, right, are cash correlating. Whereas for STI is unique, it is cash derived. It follows the STI index quote, but then there are spread a bid and ask spread. So what are indices? So CFD indices is a form of CFD that allowing our clients to trade the underlying cash index. It tracks the performance of the cash index. However, just take note that the prices may differ from the cash index itself. So from this chart, right, you can see how we can trade this index. Take STI, a very familiar name to all of you. So if you think that at 3,000 level, you think that STI is very bullish, you think that it can go up to 3,004 or 3,005, you can take a long position with this STI $5 index. So when the index go up to 3,300, you can think that you don't want to wait anymore. You can take profit at this level. So you're effectively making a 300 points of profit. And then if 1 point is $5, so $300 times $5, which 300 points times $5, which can give you a $1,500 of profit. But this does not include the commission and the financing charges. So this is how you can profit from the index. Whereas if you think that this index is too bullish, you think it's overbought already, so you can do a short selling with this CFD index. So when you do short selling, right, maybe at 3,005, so you can do a short selling and then you cover it back. So when you just click a sell button to short, and then you can buy back at 3,001. So this gives you a 400 points of profit. So why people trade CFD indices or trade index? It's because they don't know which shares to buy. So index itself is the movement is actually mirroring, is correlated with those big component shares. So in the event that you are too busy to analyze individual stocks, but you think that overall market will be good for next year in a couple of months or couple of weeks. So you can use the index directly. So that's because it tracks the performance of the stock market. So the specification, just an example, for a Straits Time Index SGD5. So each point is $5, as I mentioned earlier. So how the full contract size is actually like doing a multiple of $5 times the price level, and then times the quantity you are intending to purchase. So that's a full contract value. And then our target spreads is quite tight. It's 3.6 points with an initial margin of 6%. The trading hour is from 9 a.m. to 4:59 p.m. Just do take note that there's a lunch break during between 12 to 1. Okay, so I show you an example of how this STI index is quoted at 3,003. If you see from the cash market, so the CFD bid, this is a price for you to sell your contract, will be 3298.2, which is negative 1.8 because the full spread is 3.6. So the middle price minus of 1.8 will be your selling price. If you're intending to purchase at this level, the purchase price will be 3301.8, which is a plus 1.8 point. If you guys have any question, can feel free to leave a question to us, or we may try to answer. We may try to answer a question if possible. Okay, so for FX CFD, it's a core contract for difference in the forex. So you can access more than 30 major global forex pairs. Currently, we have 36 pairs to be exact. So it's a kind of currencies trading. So you heard of a lot of your friends, maybe your neighbor, your nephew are trading FX. So CFD is one of the products that allows you to access to the forex market. It tracks the performance of the underlying spot forex. Unlike you don't need to go to money changers to buy this to buy this exchange and then subject to a lot of spread, you need to hold a big, huge sum of cash. But this one is with margin. So it's just a small initial deposit you can buy Forex already. The margin is as low as 5%, which gives you a 20 times leverage. So the minimum contract size we offer, contract is 10,000 shares for the base currency. Contract size for the base currency, because this allows our client to craft your own quantity, such as you want to buy 10, you can become a 100,000 contract size. So this give you a very flexible way to craft your trading. So Euro, for instance, the first pair, Euro USD, I think this is one of a very popular market, most popular one and very liquid pair. So the contract size is Euro 10,000. Whereas for the second pair, AUD against US dollar, the contract size is Australian dollar 10,000. Okay, so show you another example. What are the base currency and term currency? So for this pair, British pound against US dollar. So the base currency is British pound, GBP, and the term currency is US dollar. So when we enter a buy or sell trade, we are referring to the base currency. So an opposite transaction takes place in the term currency. So when we purchase a forex pair, so effectively we are buying a pair or buying a currency and selling against the other currency. In this scenario, British pound against US dollar, when we long this position, we are buying the British pound and we are selling the US dollar. So you need to understand the quote. So if in the event this British pound against US dollar is 1.3, which means that $1 of British pound can be exchanged for 1.3 US dollar. With our familiar name, US dollar against Sing dollar, which means that $1 of US dollar can exchange for 1.33 or 1.32 of the Singapore dollar. So in the event if the quote go up, if you're in the long position, then the price become 1.45, which means that $1 of British pound can exchange for 1.45 of the US dollar, which could means that British pound strengthen or US dollar weaken. Based on the quotation, so the profit and loss will be reflected in the term currency. So as you can see that 1.45000, right? So the quote, right, the quote for the Forex is called PIP. PIP is a standardized unit referring to the fourth or second decimal depending on the pair. So the movement is counted by PIP for all the currency pairs. So for the normal currency pairs like British pound, US dollar, or US dollar against Singapore dollar, and dollar CNH, all these are offer up to 5 decimal places. So a PIP is referring to 0.0001 movement. So it's a fourth decimal place. For currencies like USD, JPY, Japanese yen, so because this is quoted in 100 yen, $1 is equivalent to 100 yen. So this offers up to 3 decimal places only. So 1 pip is referring to 0.01, which is the second decimal place. So one movement is 0.01 for this pair, USD, JPY. So for the contract size, as I mentioned earlier in the previous slide, it's a 10,000 in the quoted in the base currency, a term current. I mean in the base currency. So the 10K contract movement of 1 pip is equivalent to $1, whereas for 100K contract, the 1 pip movement is $10. So you can minimize your exposure in the initial stage, and later when you are more familiar with FX trading, you can actually size up your contracts. So how to calculate the profit for Forex? So when you long bought one CFD GBP USD at 1.3, when the price go up to 1.45, you are making a 1,500 of profit. The calculation is just like 1.45 minus 1.30 times 10,000 of the contract size if you are purchasing one contract with us. So for long, second scenario, in the event that the price went down to 1.35 and you purchase this contract at 1.4, so you are making a loss of $500. So 1.35 minus 1.4, which gives you a 500 loss times 10,000 contract. Yeah. Okay. So for swap points, right, because CFD, FX CFD, you don't have commission and anything. Swap point is basically when you hold this FX position overnight, which you hold past 6 a.m. of Singapore time, depending on the daylight saving and non-daylight saving. Currently, it's non-daylight saving, so the market closes at 6 a.m. Singapore time. So your position risk, you either have a gain or losses in the swap points. So this swap point is actually the interest rate differential between the currency you bought and sold. So interest that you earn when you bought an currency with a higher interest, and because when you buy a currency and you are selling the other one, so this is we call it in a pair. So when the one you purchase has a higher interest and the one you sold has a lower interest, so you are receiving you have a chance of receiving the swap point because could be a positive swap, but depending on the market condition as well. So the interest is earned based on the currency you earn, and the interest is paid based on the currency. So in this case, you are earning more interest than the interest you are paying. So your interest the swap you gain or loss will be credited into your CFD account, will be reflected as a swap point adjustment. So after talking about FX, for all the CFD products except for CFD DMA, when you buy, your order will be done at the price submitted based on the ask price quoted in the market. So this provided all the pre-execution checks are satisfied, such as you have sufficient funds inside your account, and you have passed all the required regulatory tests before you're trading CFD. So in the event all this pass, your buy order will be submitted and will be filled based on the ask price. So your sell order is the other way around. Will be you need to refer to the bid price. So you want to sell, you need to sell at the bid price for CFD, normal CFD, equity CFD, commodities, FX, and world indices. So this is a screenshot for you to refer. So this is the place for you to sell your contract, and this is the place for you to buy your contract. So doing short selling, you just click. If you want to do a short selling, you just straight away click this price, 3298.2. So you can successfully doing short selling, but subjected to the bid and ask quote movement as well. If it is too volatile, your order may not be matched because the price may have ran away when you click the submit button. Same goes to buy. You need to use the ask price for the normal CFD. So how this CFD order are being filled and being done? So you place your CFD Q trade. So you can just place your trade based on the ask price and the bid price. So all the pre-execution checks are performed on your account, such as the fund sufficiency, credit limit, and account status. So your order for normal CFD, your orders will be routed to CFD Hedging for CFD market making team for processing and subjected to risk management checks. So your order will be queued in the CFD system should the order be accepted. So for CFD, you can queue your order, but then it will only for buy order it will only be filled when the price flip to the ask side, or your sell order will only be filled when the price flip to the bid side. So bid and ask matches sell order respectively. So your order is filled when the broker is able to hedge its exposure. This is for conventional CFD. So here are a few examples for you to as a guidance for you to look at it on our Poems 2.0 platform. So I came up with several products such as DBS, Gold, and Wall Street Index. So if you want to buy a Wall Street Index at 30,102 points, So you can straight away hit this ask price. Or you can see this DBS quote is if you want to buy is 25.48, and then the bid is 25.45. So this is the price for you to sell or do short selling for your DBS contract. Okay, whereas for DMA, right? As I mentioned earlier, just repeat again. So I think that your order will be reflected on the exchange order book. So you can refer to the market depth for your transaction. So since your transaction will be updated on the exchange order book, so this is the market depth before you submit your DMA CFD order. So in the event I want to buy 1,000 shares for these shares, 1,000 at 0.85. So I can queue at currently is 48,000 people. The volume is 48,000 is queuing there. So when I add another 1,000, right, it will become the 0.85 will become 49,000 with additional 1,000 quantity inside. So move to the next part, how to use CFD instruments. So CFD, as you all know that CFD is very flexible. We have offer multiple contracts. We have can do short selling, can do a lot of things with CFD. So now let's check out what we can do with CFD. So first of all, of course, it's trading, or maybe you want to use CFD for investment, it's also good. So you can buy and sell or even hold this CFD position for long term with small upfront capital, which gives you an more additional cash for you to do other things like such as you want to pay your mortgage, you want to buy new houses. So if you use CFD, you can free up some cash to do other things or spare for emergency purposes. So this is a small cash upfront. That's one of the advantage for CFD for trading and investment. For scalping, right? A lot of people like to scalp the market, such as they think that this market is going to move up for 5 days or 3 days or even 1 hour. So with cash, right, your trading power is quite limited, just limited to the cash inside your account. But in the event that you can use CFD leverage with small initial capital outlay, you can enter a bigger position. So this can maximize your gain, but also to take note the downside risk as well. So the short price, because we think that normally the short-term price movement will not go double in 1 or 2 days, maybe 10%, 20%. If you use cash, well, $10,000, 10% is just $1,000. But if you use CFD, maybe you leverage using $5,000 with a leverage of 10 times, so you can buy up to 50,000 of this position. So 10%, which gives you a 5,000 profit, which is way higher than the 1,000 profit you are able to enjoy with the stocks, normal equity without leverage. So some people also use CFD for sophisticated trading strategies such as arbitrage or their self-developed strategies, or even using it for hedging purposes. So because people can use this what we call that FX to maybe complement with their equities or their foreign shareholdings, can do a lot of things with CFD. So this CFD is only for trading. I think I would like to request all of you maybe can share us what you think that CFD can help you in your portfolio. Just feel free to write your comments on the Facebook Live, or maybe just drop a question to us, like maybe give us a suggestion, so that maybe you can come up with something that is out of the box or out of something that I may have thought of. Then I can share it in the next few webinars, or maybe my colleagues can share with other participants, so that we all can help each other to leverage the benefits of CFD, the flexibility of CFDs. Okay, while you're taking a comment, please allow me to continue with the next slide. So what is hedging? So CFD can do hedging as well, can do trading, investment hedging. So in life, you buy insurance to hedge against negative events. So your negative events such as motor insurance for your car vehicle in the event that meet a disaster, natural disaster, or maybe accident on the road, minor accident, of course. I mean, not cursing anyone. So this can give you a protection. You don't need to pay a lot of money when your car meeting this kind of unforeseen events. So in investment, some of people they invest, right? I received some of the inquiries from clients in the midnight, and they say, how are the market is dropping? I'm not very comfortable. I cannot sleep well. So a lot of people have this concern, So it's either, I don't really encourage people not to stay out from the market, because if you stay out, you miss out a lot of opportunities. But one thing you can do is hedge against your investment. So if you think that the market is too bullish already, it's overbought, so you can hedge your position using CFD, which I'm going to talk about in the next few slides. You can either use the equity or maybe for your world indices to hedge against the price movement. So it's actually a protection against the downside or when the portfolio move against you. So we can either use CFD, inverse ETF to do short selling, and also futures. So okay, assuming looking at this chart, right? Assuming client A bought one lot of a ABC component share at $25 on 3rd December. So, but you think that the price may tumbling down soon after. So the client can do a short selling with what are the shares or maybe world indices such as SDI index. So let me give you an example. So what can the client do, assuming the client do not trade a CFD, do not have a CFD account, don't know what the CFD, just buying the share. So bought at $25 in the previous slide. On the 4th January, the position was sold at $23. So this people is making $2. This person is making $2 loss times 1,000 shares is $2,000. And with the commission and the exchange fees, the net loss is $2,147.6. So it's a huge sum compared to the initial capital. But if you use CFD, you can establish opposite position using equity CFD or world indices CFD. So you can fully hedge your position by establishing an opposite direction. So if you're buying a you're buying a share, you can do a short selling with a Shern share at a higher price. So this will lock in your selling price. So why do people make this hedging? Why do people do hedging? So sometimes when you enter the position, such as the DBS during the March crash, you may get it at $17. But then when it rise to $25, for example, you think that maybe it's not the right time to liquidate your portfolio because your investment goal is to receive dividends for this share. But if you don't want to receive, if you don't want to miss out this, you don't want to share a position, but you're afraid that market is going down, I'm worried that all my capital gains will be vanished in overnight. So you can do a short selling at maybe 25 or 24.90 or 24.80 to do short against the negative adverse movement for the short term hedging, so that it will protect your capital in terms of protect your position in terms of the capital gain. Or you can hedge partially by using doing a opposite direction in the cash correlated instruments such as cash derived instruments such as SDI index. So these are the good hedge for those index linked stocks, blue chip stocks. So this is an example for hedging. So this client short sell this SDI contracts at SDI $5 at 3160 on 3rd December and buy back at 2994 on 4th January, assuming this is a bearish conditions. So the gross profit from your world index, right, is 3160 minus 2994 times $5 times one contract, and your profit from this trade is 830. With your commission and everything, your net profit is 765.88. So this profit, right, can use to offset the capital loss from this from the stock A, which is the net loss of 2,147.6. So your net loss will reduce significantly to $1,381.72. If you want to hedge, fully hedge your position, you can use equity CFD. So you can do a short selling position at 25 and bought back at 23. So this gives you a net profit of 1,844.26 after commissions and the financing charges. So the net loss for this client in this bear movement is only $303.34 instead of $2,147. So I believe that all of you have seen the benefit of doing hedging. So you don't need to hedge directly like 1,000 shares directly. You can also use single equities CFD security to hedge partially, such as you hedge only 500 position. It's up to you, depending on your risk appetite and depending how worried are you on the market condition. So commission, right? So since we have shown some examples with commission and financing charges. So now I'm going to talk about how this commission is calculated. So it is applicable during the opening and closing of your CFD positions. So for equities, right, it's charged based on the full contract value. So it's the price you bought times the full quantity and then times the percentage, multiplied by the percentage the commission rate. So if the CFD trades done on the same day and same counter, same contract type, it will be charged on an amalgamated basis. So as you know that we all charge the we charge the minimum com. So the minimum commission will not be charged twice if you open and close the same position on the same day. It will only be charged once and subjected to the percentage as well, whichever is higher. So for commodities and world indices are charged based on a per contract basis, regardless of contract value, and it's per site when opening and selling, the commission will be charged. So for FX, I mentioned earlier, we have no commission. It's only swap point. Subject, you may have a positive swap which we will be receiving if you long the position, or negative swap you could be subjected to the swap. You need to pay for the swap. So financing charges is only applicable to those positions that are held overnight. So let's say today is a Friday, you bought a Singapore share, CFD. So you will not be charged if you close this position before the market close. But financing charge will only applicable if you hold this position until now, which is you're going to carry to the next trading day on Monday. So one night of financing charge will be applicable to your position. So it is a accrued basis. Daily basis will be realized when your contract rollover. So we have a contract rollover for 30 days. But then this will not incur any additional cost. We will just book the P&L and the financing cost to your account. Or when you liquidate your position, like let's say you liquidate this position you bought on Friday, on next Tuesday. So there will be a two-day financing charge applicable to this position. So for day trading, I mentioned earlier, there's no financing charges applicable. So how the financing charge is calculated? So it's based on the closing price, the market value, closing price times the quantity times the financing rate. So we can see from the screenshot, right? You can see the gross contract value, margin requirement, and long and short financing charge. So you can use this percentage as an indication that how much you will be charged per night. So of course we charge it daily. This is per annum. So give you an example, if you long an Amazon position, on the third day, assuming that the financing cost for this Amazon is 4%, so the market value for the first day is 31,000 and the second day is 35,000. So 31,000 times 4% divided by 365 days, because this is only the day one night only, and the second one is 35,000 times 4% divided by 365 days. So the total financing cost is $7.24 only. Okay, so we talked about how to use these instruments, how the charges being derived, and previously we talked about how to buy CFD and the contracts we have here. So a lot of people may think that leverage product may magnify my losses. Should I use stocks only? I think that you have to be more nimble and more agile in your investing strategies. So I think trading disciplines is very important, regardless you're trading stocks or CFD. When you're trading CFD leverage product, when you have trading discipline, I think that your trading journey is more sustainable and the chance of making profit is quite high, because you know how to manage your risk, you protect your downside, and then let your profit run, so your upside is limited when you long a position. So trading discipline includes stop loss for every trades, and then you need to budget, maybe give your capital to risk per trade, and then the risk reward ratio. So you're comparing the risk, how much risk are you taking and how much reward are you going to have in this trade. So first of all, we start with the risk reward ratio. Putting your money into market, of course, have a certain degree, right? I believe that all of you should have heard of this word, high risk, high reward. So if you want to be compensated, you need to take some risk. Of course, whatever you do in your life, it also comes with risk. You want to start a business, also with risk, comes with risk. If you put your money inside the bank, the risk is very low because you are protected by the central bank in certain cases. So, but of course, the interest rate is very low. You want to do investment, you are looking for higher return. Of course, this always comes with a risk. So a lot of traders or investors use the risk reward ratio to compare the expected return of an investment. So the optimal risk reward ratio may differ among your strategies. or maybe your risk tolerance level. So the risk, you can be taking $1 of risk with the reward of $2, which give you a 1:2 ratio, or you can take a 1 to 1.2. Of course, the higher the reward, risk reward ratio, sometimes may also associated with a lower probability of getting it, because your reward is way too high. The chance of the share price hitting your reward level may take very long. The chances is very low. If you have a very tight risk reward ratio like 1:2, the chances of it happening is slightly higher. But of course, that depends on your individual risk appetite and your trading strategy. So with this risk reward ratio, right, especially when you're buying a share with you're chasing a trend, and then you chase a false breakout, then you are protected because you have your entry and exit point. So always enter a position with two exit points. One is a cut loss, one is profit taking. So your path is clearer with this entry and exit points. So how to calculate the risk reward? Let me show you a few steps, simple steps. So when you calculate your estimated profit target from current price, so let's say you want to make a $1 of profit, and then your loss would be maybe 20 cents. So you need to calculate the stop loss target price from the current price. So in the event you enter this position at $1, and then your profit target is $2. So this is a $1 of profit, and then you are risking 20 cents of the risk only. So you need to calculate the risk reward ratio. So you can do it by dividing the reward $1 by 0.2, which gives you a 5 times. So your risk reward ratio will be 1 to 5 risk reward ratio. If the risk reward ratio is $1 of risk, you are maybe being rewarded with 0.8 of the reward, then I will suggest you not to take this trade, because it's not really worth it to take this trade, because you are risking more than the reward. So this is one of a breakout chart. As you can see that this level 1.18 is the resistance level. So a lot of people may enter it slightly higher than the breakout point to avoid some of false breakout. So in the event you want to enter at 1.21, you may set your profit target at 1.39, and then your cut loss point at 1.09, which is a 0.12 of risk and 0.18 of reward. This risk reward ratio is 1 to 1.5. This 1 to 1.5, I have seen a lot of traders online using it, but then there are more ratios, because this is very flexible. It's up to your individual preference. There's no hard and fast rule. There's no there's no best set of risk reward ratio in the market, unless you did a lot of backtests based on your personal trading strategy. So as I said, capital to risk on the trade. So you need to budget your trade, how much you're going to lose this trade. And then after losing this trade, I'm enough of it, I want to exit this trade. So regardless of how much research or how good you are in the market and how selective you are, it is inevitable and counter a losing trade. So the best trader in the world will also have some losing trade. Okay, so it is a matter of how we manage the risk of a trade and how we let the profit run. It's about how much we make when you are when the market is in our favor, and how much we lose when the things go against you. So losses can easily get out of your hand and if not control. So some of people can lose everything in their account, but then we don't want to be like them, because this is a disaster, will traumatize you for the whole life. You may not touch shares, you may not invest for your whole life. So one of the most common people set the risk is 2% of your total capital. But then I would, in my opinion, that I think 2% is a bit tight, but that depends on your personal trading preference as well. So because $1,000, if you're putting a capital of $1,000, $2 is just $20. If you are putting a 1 million, 2% is 20,000 already. So depending on how much is the capital, and then set accordingly. So I think why we need to have this kind of capital is that to protect you, to save capital for your next trade. In the event this is forced, you have made a wrong decision, so you can quickly move on to the next trade to make back, or maybe make even more. So as you all see that losses can be very disaster. So the original sum I put it into my Poems trading account, 10,000. So let's say I make a loss of my risk, my capital to lose is 20%. So in the event hit the stop loss, I will be making a loss of $2,000. So in order to make back this $2,000 out of your 8,000 capital left, you need to gain additional 25% in order to get back to 10,000. Whereas if you have a very tight 2% only, so you're losing just 200 from your 10,000 capital, so you're left with 9,800 of your capital. So if you want to make back to 100% capital, you just need 2%, 2.04% of gain. So I would say this is very flexible depending on your risk appetite and your strategy. So most of the common mistakes by most of traders is not putting a stop loss on their trades. A stop loss order can automatically cut your position once your trade hits a certain predetermined criteria. So because I have some trading experience before, I've experienced never cut loss and cut loss within a very tight range. So if I don't cut loss, right, my mental is very weak. I'm mentally weak. I'm concerned about my positions. I cannot sleep overnight. And when I tend to average down when the price just drop a bit. So I'm not really in a sound mind. My mind is not clear. So I can enter position whenever I want. I can do a lot of revenge trades in between. But once I adopted this stop loss for every trade or have determined the cut loss point, my mind is clearer. So when the share price move against me, I cut loss. And when the share price drop further, I wait for the market, wait until the buy signal come out. I only enter back to the position, because you all must understand that whenever the share is there, you can always enter back after the cut loss. So don't afraid that you lose this opportunity. I cut loss means I'm a loser. No, you can even make bigger after you cut loss and enter at a lower price, buy a bigger position, or buying the same size or buying a smaller size. That depends on the strategy. So here are the few synthetic orders that currently our CFD site is offering. Stop limit order. Stop limit order is actually combining with feature that with a stop order with a limit order. So once your stop price is reached, a stop limit order will send to the market, send to the CFD exchange to buy or sell specific at a specific price. So this effectively can help you to cut loss. A trailing stop is actually which I'm going to talk in detail in the next slides for trailing stop. OCO1 cancel others is actually incorporating the element of stop limit order and the normal limit order. So this order allows you to take profit, set one order to take profit, and the other wing of this order will be a cut loss. So you can take profit and cut loss, or put your take profit order and cut loss order within the same order, which is very convenient. And contingency order is only will be filled under if the certain conditions of the security or another security has been filled. For example, if you are intending to buy OCBC at $10, so your condition may set at maybe when DBS cross $25 mark, you want to buy DBS at $10. So you can use this contingency order, or you can use if done order when you have one existing order, such as you want to buy StarHub and Singtel. So once your StarHub order is done, you want to buy Singtel at what price? So once your StarHub order is done, then we'll send another order to buy Singtel at your based on your predetermined conditions. This is called if done order. For most cases, you want to do cut loss. I think that the first three will be good enough. Stop limit order, trailing stop, one cancel order. So what is trailing stop? So trailing stop is actually you set the percentage between the entry, such as you set the percentage 10% below your entry price. So when the share price move up, right, the trailing stop price will move up in tandem as well. So when you bought these shares enter these shares at $5, 10% is 4.5. So when the price it moved down to 4.5, it will help you to cut loss, to take your losses. But then in this scenario, I'm going to show you the share price go up to $10. So your trading will move up to $9. So when the share price drop down, so drop to $9 is $1 decrease. So the peak is at $10. So the trailing stop will stop. Will still at $9. Will continue to be at $9. It will be determined based on the peak price of the securities of the CFD assets. So when the share price move up further, the trading price will move up, move to 13.5. So assuming $15 is the peak for this particular CFD shares. So when the price U-turn down, maybe drops to the 14.2, this is the place where the trading stop still remain at 13.5. When the share price drop further to 13.5, your position will be closed. But all these synthetic order, including stop limit, OCO, this if done order, is not guaranteed fill. It may be subjected to the market volatility, liquidity, and even in the event the share price gap down or gap up, your order may not be filled. So this is how to use stop limit order. This can effectively protect your positions to limit your losses. Same, this is not guaranteed fill. So assuming you enter the same share at $5 and you set the stop price at 4.3 and the stop limit price at 4.28. What is stop price? A lot of people have been asking me or my colleagues. So stop price is actually the price where it will triggers the CFD system to send an order to help you to cut loss. So the limit price will be the order will be sent to the market. So the limit order will be 4.28. So the lowest price you could get out from this trade for this long position is 4.28. However, subject to the market volatility condition and volume. In the event there is no volume for you to cut at 4.28, then your order will be remain there as order received, will not be filled. So in the event the share price drops to 4.65, so which is approaching the stop price, this stop price, unlike the trailing, will not move. This will not move. Trailing will move up accordingly for the long position. And the share price went up to 5.1, still remain there at 4.28 and 4.3 for the stop trigger. So, and then the stop reached a peak of 5.1 and dropped to 4.3. Then when the share price dropped to 4.3, the CFD system will triggers an order, stop limit order at 4.28 to sell this position. So your position could be closed at 4.28 depending on the market condition. So the key points to take note is leverage is a double-edged sword. So please take note of your risk, and then your risk-reward ratio. When you enter the trade, I would strongly suggest you to determine your risk-reward ratio, because no one is 100% accurate. So you need to think that if the risk-reward ratio is good, then you only enter the trade, and do not overtrade. Do not trade more than what you have. You get what I mean? So do not over leverage. Leverage is good, can magnify your returns, and maybe in the event loss, you need to think that what is the worst case scenario? Can you stomach the losses? So do not overtrade, trade within the mean. And then must have I mean, it's not a must, but then I will strongly encourage you to have always have a stop loss to cut your trade in the event that you are not aware of the trade, you're not monitoring your position, you have a stop loss, so it gives you a better peace of mind. And then record all your trading journals, keep record of your trade. So this you can record down why you lose this trade. Maybe you can do a post-mortem for your trades so that you can improve your trading strategies, improve your trading skills eventually. So after talking about this trading discipline, I'm going to show our audience on like how to open a CFD account, because I believe that you have traded normal equities. Having a CFD account, it is totally free and you can enjoy some of our promotions. So you can just open a CFD account to try some of the trades to see if it's suitable for you. But I believe that with CFD, that it can give you more flexibility in your trading. It can complement with your futures or your stocks trading. So if you're in front of PC, if you're not in front of PC, you can take a photo for this slide on how to open your CFD account if you are existing Poems clients with stocks account here. So we can simply go to the account management tab. And then under account management, you can go to CFD tab. And then on the left-hand side, the last second row, you can go to online account opening. So you can open your CFD account here by filling out the form here and wait for the email notification. If not, you can also contact a dealing team or your broker for further assistance, or call our customer service hotline. So if you are new to Poems, if you are joining us as a guest, you are most welcome. And I will also suggest you, if you want to trade CFD or you want to trade equities, if you are local, so you can, if you are foreigner also can, please visit this website, poems.com.sg, open an account, which is I think on the left-hand side corner of the page. Open an account, you see this. And then if you want to have a CFD facility, you can take this contracts for different CFD here, then continue with the application. The process is very seamless. So you can have one account with multiple facilities, one cash trading account for stocks and CFD under one account, one login. So you can play around with it with your portfolio. I mean, you can customize your portfolio based on this flexibility given by Phillip Securities or Poems. So a lot of clients has been wondering, what if I have a stock account? When I open a CFD account, how should I fund my account? Okay, there are a few ways to fund your CFD account. One of the direct way you can transfer from your existing cash, your excess cash from your stocks trading account by simply clicking go to account management. Then if you have a existing stock account, go to stocks and then online forms. Online forms are step number 3, and then step number 4 is go to withdrawal form and key in the amount that you intend to transfer into your CFD account. This is step number 5, and step number 6 is which is the last step. And you choose the toggle, choose the account number you want to transfer, and then with a bracket CFD. Then the funds will be transferred into that particular account, CFD account. Then the purpose you can write whatever you want. I mean, as long as it's suitable, and then click submit and key in your password. Then your account, your fund transfer will be processed based on the cutoff time. Alternatively, the faster and easier way, you can use PayNow. As you all know, that PayNow is very is a lot. I think a lot of people have been using the PayNow currently. So PayNow will be processed within 15 minutes, except between 11:15 to 11:45, and from 5 a.m. to 9 a.m. These are the we call it non-PayNow time. So the currency is in Singapore dollar. So you can get this UEN number through our website as well. You can simply Google payment instruction, Phillip payment instructions, and then you enter the site and click the pay now. You can get this UEN number. If not, then you can also capture it from your phone. And then for the rest, if you want to transfer into your CFD account at the reference part, you just key in your CFD account number, 7 digits, must be 7 digits, followed by the alphabet 3 letters, CFD. Then the funds will be credited into your CFD account, subject to there are checks and balances, such as risk management, and then the account belongs to you, because we don't accept third-party transfer. So if everything is all right, your funds you should be able to utilize your fund within 15 minutes or after 15 minutes for the transfer. Okay, so I think that a lot of you may have is in the midst of clicking the open account online, or maybe opening CFD account facility, right? You can also check out our promotion page, which is on the phillipcfd.com/promotions. You can scan the QR code. This is not the safe entry QR code. This is the QR code for access to Phillip CFD website. You can check out our promotions here, and then you can enjoy this trades promotion and be referred to your friends as well, and recommend it to your friends, so that everyone can enjoy this CFD trading, this flexibility. Thank you for your time. My name is Yong Shern again. I'm a CFD dealer from CFD department, Phillip Securities. If you have any inquiries, feel free to call our hotline 6336-338. Or you also can email your inquiries to cfd@phillip.com.sg. If you have any inquiries regarding the CFD products, you may feel free to drop your questions in the Zoom or through the comments on the Facebook page. We will try to answer your question as much as we are possible. Thank you for your time. So now is the Q&A session. I'm going to answer your questions one by one. I mean, those questions that I'm able to answer. Thank you for your time. Hope you enjoyed this webinar. Please like or share this webinar. Since this webinar is recorded, you also feel free to replay this webinar. Thank you. Okay, so I have the first question that one of client checking that some of the CFD provider, they're quoting different price from the market, from the cash market. Yeah, that depends on the brokers, their strategy and their policies. So for Phillip, we are quoting exactly same as the cash market, except they're subjected to a bid and ask if you're using the normal CFD. If you use DMA, it will be 100% same as a cash, except it has the short selling function and then the leverage function. So that because maybe this is the way they do around with their pricing strategy, which you need to check with the broker. But for us, we mirror exactly the same for equities. Hope I answer your question. Thank you. Okay, can Cash Plus account be used for CFD? Yes, any account for with Phillip Poems, you can open CFD account facility, there's no issue with that. You can straight away just go to account management, then CFD open your account online, fill out the form and pass the CKA test subject to the risk management, and then fund in your account. Then everything should be good to go. Okay, can stop limit and market order be used for CFD on CFD and market order? Yes, stop limit order can be used for selected products. I think those like such as Singapore market and your indices, you can use the stop limit. For market order, you can use it for US market. That depends on the market you are intending to trade. You can feel free to explore it on our platform. You just simply key in the product you're intending to trade, and then you click the order type, and then normally by default should be a limit order. Then you see the options available. We offer market order and stop limit order for selected products. But I would say a lot of products we are having it, but there are certain market that we are unable to provide at the moment, but we are still in the midst of upgrading it. Okay, okay, explain more about details of CFD DMA trading. Okay, so CFD DMA trading is just like, just imagine yourself trading the stock market. In the stock market, your orders is being sent to the exchange, and then it can enjoy the facility of CFD, the flexibility of CFD. You can leverage, you can use margin to buy only 10%, maybe 20% or 30%, depending on the counter you're intending to choose. And then you can do short selling with CFD. This is the advantage of DMA CFD compared to stocks. But if you want to compare DMA CFD to normal CFD, the commission rate is slightly higher than normal CFD. CFD is a market make product, so your purchase, you queue in the order will not be may or may not be reflected on the exchange, and it will only, you can only get the ask price. You cannot get the bid price. Whereas for CFD DMA, you can get the bid price, which is the lower price, but you need to queue subject to the volume and the market liquidity. You may or may not get the order done for this DMA CFD depending on the queue as well. So hope I answer your question. Thank you. So this 10% margin are actually set by the authority, and then as well as our risk assessment, so that we set our minimum margin for equities is 10% for index link. So the commission and financing charges, you can feel free to check out our website at phillipcfd.com and pricing. So you can look at the minimum com as well as the commission by percentage on our website. For financing charges, you can also check it out. We have an indicative rate on our website. But for individual counters, because the short selling, the short financing charge is a bit more flexible, because depending on how hard we can borrow the shares for you to do the short selling. So you need to check this financing rate on the individual counter on the trade order ticket. Under there, you can see the short and long and short financing charges. You can get the rate there, or you can get the long financing charge on our website. Yes, this recording is recorded live. You can just feel free to visit our Facebook page to replay this webinar. I hope that you enjoyed this webinar. Thank you so much. So yes, investor can hold CFD for long term, and you read through the info sheet. Thank you for reading our CFD info sheet. So other clients, you're also invited to read our CFD info sheet. You can get it from our CFD website or Google it for CFD info sheet. This provides you a very in detailed explanation on how our Phillip CFD, our contract works. So yes, it will be rolled over every 30 calendar day. You don't need to re-enter a new, you don't need to enter manually. Everything is automatically done. So what will happen is we will charge the financing cost, realize the financing charges, and realize your P&L book into your account only. But it will not incur additional cost to you due to the rollover. So your contract will still be there. The process of this rollover is just to realize your financing charge and your P&L only. Hope I understand your question. If you have further inquiries, you can feel free to call us or call your broker to understand more about this rollover mechanism. Okay, so if you long SGX shares during dividend, yes, you can participate in the corporate actions such as dividends. For rights, right, depending on whether it is renounceable or non-renounceable, we do not cater for rights subscription, but we cater for renounceable rights trading. So you can liquidate your rights, your rights, the renounceable rights through us, the dealing line, through via manual order. So you can liquidate the rights. For dividends, we'll just credit the funds on the maybe X date or X date plus one for the dividends. For our index CFD, right? Yes, the closing time you can check it out on our website. So it's longer than the cash trading hours. Because we offer this opportunity for clients to enjoy, such as the US non-farm payroll, this announcement, right? Some people may get out of hand if they have holding the Singapore position, so they can buy or maybe short the US position to hedge against their local shares. So this is one of the benefits that why we offer longer trading hour for our index CFD. Okay, so for CFD trading, you can do you need to pass the a test? Yes, you can do the CKA test on our Poems platform. You can also feel free to contact your broker on how to do it. So this is under account management on the Poems platform. Then you can go to under stocks. Then you go to CKA and CAR assessment. So in the event you pass that directly, so you don't need to do any additional course or online e-learning. In the event that you do not pass, then you can do a e-learning through the ABS website, Association Bank of Singapore. This e-learning is quite, I mean, you can learn something there. And then once you pass it, just send the certificates to cfd@phillip.com.sg. Then we'll have it to process, and then you are good to initiate your trade after depositing the funds. Can I trade in USD but only have SGD in my CFD account? Yes, you may. You may trade using this Singapore dollar to initiate as a collateral for your USD position. But just take note that there will be a margin deficit charge. So I would encourage, if you really urgently need to initiate the US position, you can initiate it by using your SG dollar, Singapore dollar, but then do a currency conversion right after the trade so that you will not incur the long-term margin deficit charges. Because it's something that I want our client to avoid this additional cost for your trading. So I hope you guys can save as much as possible. So what are the difference between the CFD and CFD DMA? I think we have this comparison on our website. So again, just repeat again. So CFD DMA is you can participate in the exchange order book. So where your orders will be reflected on the exchange market depth. Market depth is the place where you can see at what price. For example, DBS $25 has 1,000 buy volume. And then when you key in 200 to buy at $25, the exchange market depth will increase to 1,002 at $25. So this is how you can see the bid and ask price, and then your orders will be reflected. I mean, your trades, those trades being filled will be reflected on this time and sale. However, the commission is slightly higher compared to normal CFD. So for normal CFD, is market make product. So the order will flow to CFD, Phillip CFD here. So our market maker will fill your order accordingly. So, but this all the prices are is based on the market, the cash market quote SGX without any additional spread. Hope I answer your question. If not, then you can feel free to call our dealing line. So for CFD, comparing your options, CFD is different because options will become worthless when the share price move against this options specification. But for CFD, you can still hold the position as long as you have enough sufficient initial margin and has sufficient funds inside your account to maintain this position. So CFD is more towards like stock trading with leverage and the short selling facility rather than options trading. Yes, there's one client asking whether you can keep CFD position for long term. Yes, you can keep CFD position for long term, but then subject to the trading status of that particular contract or particular securities. In the event you are buying shares, as long as the share remain listed and not in the liquidation mode, you still can hold this position for long position. Whereas for short position, you can also hold as long as possible. But then just to take note that in the event there are certain corporate action that for short position we are not able to cater, we may request you to close the position. But then this happen very very rare, because we will cater. I mean, we'll try to cater as much cooperation as possible, because to allow our client to hold this position until as long as they want. Okay, so for CFD trading, right? I believe that we have running late, so I will answer one more question. If I did not answer your question, I'm very sorry, but just feel free to drop us an email or call our dealing line, or you also can contact a reminder if you have any inquiries regarding to this CFD trading. So let me see. So if you short the SGX position during the dividends and rights allocation, right? So for this dividend, you will be debited. So you need to pay the dividend for SGX shares if you do a short. Okay, so for rights allocation, that depending on whether we can cater or not, this will be case by case review. So in the event we cannot cater, we will inform the client or inform the remiser. So the remiser will inform you to maybe take some action. Okay, thanks for everyone's time. I hope you guys enjoyed this and I did answer your question. I really enjoy speaking to you all. I hope that I can see you all in the next webinars, or maybe in the future after this COVID in the physical seminar. Thank you for your time and have a good day, and Merry Christmas and Happy New Year in advance. Thank you very much.